it's hard for me to believe that not everybody is conscious. Look at all of the layers of insanity that's happening out there for everybody to see. It's not hidden anymore. So yeah, I mean, more and more people are becoming conscious of it. But a lot of the problem is that people don't know what to do. It's that normalcy bias where, so it will, but wait, look at the stock market. It's going up. Neil, it wasn't just the stimulus. They changed the rules of the game. They put in those mortgage moratoriums and then they extended the moratoriums and then they supplemented the losses to the investors down the line so that they did not know and do not know the truth. So how long can they keep doing that? And as you mentioned, buying the mortgage-backed securities. So go ahead, put on a mortgage, but we're going to take them off your balance sheet. And when we don't take off your balance sheet so you can make more loans, we're going to turn into products, securitize them, and sell them to, pardon me, stupid people that don't understand what they are buying. It's really kind of interesting because I think it too is all tied in. But presumably, the Federal Reserve does not intend to issue a CBDC until 2023. Now, 2023 is kind of interesting, but they introduced the Fed Now accounts last year, which are accounts that each individual will have at their given institution, large commercial bank, or even at the post office for rural communities, at the credit unions, as well as the community banks. And they have all the beautiful graphics they have. So I was kind of curious as to why they would introduce this service in 2020 when they don't intend to introduce the CBDC until 2023. What else is happening in 2023? Oh, the LIBOR that they tested in October, shortly before they announced the Fed Now accounts. They ran that big test of 80 trillion in derivative bets, and they found that it was a big fat bust. Not that you and I could find that it was a big fat bust, but it was shortly after that they then postponed the transition until 2023. LIBOR is an interest rate benchmark that was created in the 80s by Wall Street, against which credit cards, mortgages, and derivative bets, and derivatives are just big leveraged bets that you can never convert into the underlying bonds. So anything that has an interest component to it, was tied to the LIBOR. But the LIBOR was just a stated rate by a few banks who would call up every morning and go, oh, gee, I think interest rates should be here. Oh, and another one would say, oh, yes, I agree, or I think interest rates should be here. So it was discovered during the 2008 crisis, and actually it came to the public in 2012, that this was just a stated rate, not based on the market. And oh my gosh, it was being manipulated.
What shock, horror.
Exactly. So then in 2012, then they knew that they had to do something different. So let's see, here we are, 8 years later, there were about 6 central banks that worked furiously on creating a new benchmark rate, but it really wasn't getting, corporations weren't really using it as much as they wanted to. So in England, they had the best adoption rate. But the rest of the world in the US, Switzerland, there were a few other central banks that created an alternative rate, wasn't really being adopted as quickly. And I actually thought it was really interesting when they were coming out with all the PPP and Main Street lending programs. I would have thought to force that adoption that they would have put all of that debt tied to the new benchmark that they were trying to promote, but they didn't do it. They did the fallback on the LIBOR. So I don't know what the number is now, but in August, according to the ISDA, which is the industry self-regulatory industry watchdog, which is a joke, but according to them, last August, there were 640 trillion in notional value derivatives that were in existence. And whenever you hear the word notional, what you really know is you don't know what the value is at risk. But there are, again, it's called financial innovation, where they can just jury rig and change things and lease it here, but count it on the books. And, this was before I knew about the print screen button, unfortunately. I know, but I was in the Bank for International Settlements in their derivative contracts. And at that time, for every 1 ounce of physical gold that exists in the whole world, because there's a finite amount. As soon as you get physical, there's a finite amount. There were 62,000 ounces of derivative gold. So when you asked me earlier, is gold an investment or, I look at it primarily as an insurance policy for my wealth. But secondarily, because it is so severely undervalued. And please tell me what other asset or instrument is undervalued. Because a rising gold price is an indication of a failing fiat currency. So it benefits the central bank for people not to realize that. But right now, where you have gold down here and silver as well, and you have, let's say, real estate up here in valuation, severely overvalued. This is going to flip-flop as we enter that hyperinflationary phase. Then you take some of those gains that you got in the gold, or like you did in the cryptocurrency, convert it into gold. You cannot have too much gold or silver. You cannot have too much of that.